Welcome back to Everything Money. As always, I'm Seth. I'm here with Paul and Mo. We welcome all our patrons all over the world. Paul, it's amazing. Our patrons are it is amazing. They're all over the world. I always joke around that we're big in Latvia, but it's just astounding that we'll be heading to Switzerland next year. And we have people in Switzerland that are fans of ours.
That want to get together with us.
It's crazy. But we welcome you in. And if you're viewing the channel for the first time, this channel is myself, a normal person, brings your normal people questions to a couple millionaires. And today we're talking about, this is going to be a deep video because we bring in a lot of aspects we've been talking about on this show for many years now. So as you know, we're somewhat well known for our 8-pillar analysis of companies. We look at our 8 pillars of fundamental analysis, looking at the numbers behind a stock ticker. We are also very huge fans of this book by Joel Greenblatt called The Little Book That Beats the Market. I invest in this, my wife as well. I recently on July 1st put 350 grand behind our Little Book stocks. We then talk a lot about the idea of normal people investing in ETFs. Now, all of these have different levels. They can play into each other. And in this video, we want to describe our thought process behind perhaps going all in, YOLOing your money, as they say, into Little Book, buying safe ETFs if you want to manage maybe a little more risk assessment, or using our 8-pillar systems and integrating it in both platforms. And so, we're going to compare and contrast these 3 ideas and how they work together. And so now I present to you, as always, Paul and Mo, my dear friends that make the show incredible. Paul, what do you explain again? Our patrons congratulate us about the day we came up with. What are the things we look at when buying a stock? And we came up with 8 pillars. So reassess that mindset of why you came up with the 8 pillars, or how we started using them on the show. So
we'll get into it more. This is our Everything Money software, and in it, you can select which pillars you want to sort by. And one of the things it does is select all, and it'll show you down below, it'll show you hit go. It'll show you all the companies that fill all 8 pillars, right?
So just to recap, so our 8 pillars are PE, profit margin, revenue growth, profit growth, shares outstanding, current assets over current liabilities. Pillar number 7 is free cash flow growth. And then we take that free cash flow and we want to do a price to free cash flow for pillar number 8. So these are our pillars that we've been using. If you're a patron, you know this. You've damn near memorized them, even though I haven't.
Was there a teleprompter there? Because you did that quite well.
Thank you, Paul.
Do you have it on your screen?
No, I've been doing it in my
I literally was watching going, oh my God, he got all of them right. It only took 700 videos, but you did it.
Thank you for that. I appreciate that. But Paul, so keep going. What you do, why we've developed these pillars and what you do with them.
Okay, so one of the biggest misconceptions is people think, oh, this has 8 checks, I should buy it.
Boom.
This has 1 check, I should not buy it. Incorrect. The reason I use the 8 pillars is to kind of give me a general idea of what's going on in the company. This will cause me to ask more questions. The 8 pillars are a great way for those of you who want to learn more about fundamentals of the company and more about the business aspect of a company to get questions answered for you. Why is it selling so high? Why is it selling so high? Why don't they have enough cash to pay off liabilities? Are they growing their income? Do they have enough profit margin where it makes their growth worthwhile? Is the revenue growth there? Are there shares out? Are they diluting you? This is the biggest one because nobody cares about shares outstanding. And I always call it the silent killer on a stock because the stock could grow. And if they're issuing more shares behind your back, not behind your back, but right in front of you, if you don't pay attention, your share of that profit won't go up as much. So you actually won't get the big return on this big growth stock. So I don't look at the 8 pillars as making my decision. I've bought 1 checks. I have avoided all 8 checks before.
Yep.
It's just about sitting there saying, what is the story here that allows me to then go ask more questions going forward? It's a start of a process.
In essence, we want you guys, if you're watching this for the first time and you say, wow, what a handsome host, I agree with you. But the point is, like, if you have never had a process, which I did not, my process was buy a stock, hope the ticker goes up. That was the process, right?
And what stock did you buy? You bought the stock of companies you liked, regardless of what their valuation was.
Absolutely. I liked the price when it was low comparatively to other higher stocks. And
why is that bad, Seth?
Well, what you'll learn in our videos is that the ticker price oftentimes has very little to do with the actual company. It has a lot to do with emotions, hype.
So what happens when you're advised to only buy stocks of companies you like, and everyone likes the same companies? What happens to the stock price of those companies?
Well, as demand goes up, the price goes up,
right.
Of course.
However, when you're looking at the future, any investment is a present value of all future cash flows. If your cash flow for the next 5 years was going to be this, $1, $2, $3, $4, and $5. And let's say the company ended right there. What would you be willing to pay for this $15 of future cash flow? 1 plus 2 plus 3 plus whatever is $15. Would you pay $1 for it?
Absolutely.
Of course. Would you pay $3 for it?
Of course.
Of course, because 3 becomes 15. Would you pay $15 for it?
No.
No, because why would you want to break even?
Right.
Right? All you can do is get your $15 back. That is what investing is. What I perceive to be happening in the market is people don't care about this. They just see growth and think, I'm willing to pay whatever it takes to get this because it's growing like crazy. You might sit there and say, no, I'm not doing that. But it's exactly what you're doing when you don't look at the numbers. Even with growth potential, what we have is we have the stock analyzer tool. In our stock analyzer tool, it actually will tell you the very first line of it is revenue growth. What are your assumptions for revenue growth? Because at the end of the day, growth is a major important factor to any stock valuation analysis. Whether it's a value play or not, it does not matter. Revenue growth is a huge factor in all growth. And let me give another example. Let's say you had two companies. One was making $1, $2, $3, $4, and $5 like before. And the other one is doing 1, 1, 1, 2, 2, and so on. Which one are you going to pay more for? And it was going to keep on its process. You're going to pay more for this first one, right?
Sure.
It's growing faster than this one. Does that mean you pay $50 for this one and very little for this one? No. What an investment will do is, and what our software will do for you is, you tell us what your desired return is. It'll tell you what you need to pay for that stock based on your assumptions of growth. That's it.
So the 8 pillars gives you we use it as a screener. A lot of people say you guys should have done your due diligence on this company before you even mention what you think it's worth. And the point is, Paul, we do the opposite.
By the way, that's the smarter way to do it. Why? I don't have time to go research thoroughly 10,000 companies. I need to be able to whittle them down to a group of a couple hundred that I can sit there and say, I'm going to look at these companies in more detail because not only do they have certain parameters I like, but they're most importantly selling an evaluation metric that I like.
So Mo, what steps do we do after we like an 8-pillar stock, or if we find a stock that doesn't meet any 8 pillars, but we still might like it? What do we do then?
That's the time you go and you start digging into the annual report. So you go see what the future plans are for this company. What they have to have some kind of plan if they're diluting themselves. What are they doing with that dilution? Is there a good point to it? Do they plan on buying those shares back in the future? Also, go to Seeking Alpha. Look at positive and negative opinions on the company. Go read different news about it. Just see what's out there. That's your due diligence right after you go and find the 8 pillars. Whether they're 8 pillars or 1 pillar or no pillars, go and do your due diligence.
So Paul, in contrast to this, or in correlation with this, is you got me on the little book that beats the market, which expand on what they're trying to do with a lot of our 8-pillar stocks. Coincidentally, happen to be little book stocks, and I invest in this. You gave me this book, and I
invest my ex-girlfriend in it and my sister in it.
I've been trusting this system, so expand on that right now.
So Joel Greenblatt is a billionaire. He has a hedge fund. He uses his little book as a starting point for him to whittle down his investments. But what he did was he went and back-tested the strategy. Now, a lot of people out there will criticize back-testing. Oh, backtesting doesn't work. A good friend of mine is a statistician. He has issues with backtesting. Got it. Nothing is perfect. However, my argument is I'd rather use those valuation metrics than I just really hope the stock goes up in price. What are those valuation metrics that he uses? He ranks the top 3,500 companies. He ranks them 1 to 3,500 based on PE, and then 1 to 3,500 based on return on invested capital / return on assets.
Yep.
He adds their ranks and then sorts them by their sum of their ranks. So if a company has the lowest PE and the lowest return on assets, it would have a 2. If one is 743 and 38, it would be 781, right? He adds, then sorts by this one, and based on that sorting number, the lowest values get ranked first. You can go to his website, magicformulainvesting.com, give him your email, sign up, give a certain market cap where you want to start at. It'll give you the top 30 or 50 stocks that meet this.
Yep.
When he backtested this over a 20-plus year period of time, it crushed the market.
And then, Paul, he spent $30 million in data research to get this done. This isn't a fly-by-night Excel sheet. I mean, he really got after it, too.
Yeah, so I believe in it. Why? Because it involves 2 metrics. The thing about backtesting that makes sense is I love it when people say, like, oh, if the NFC wins the Super Bowl in the year of an election, this party always wins. It's like, that's not, because those things have nothing to do with each other. There's no correlation.
Yeah.
But it does make sense that the companies with the lowest PE, which means you're paying less for earnings, and the highest return on their invested capital would do the best over a year period of time. That does make sense, right? It's just like in chess. I tell my friend Matt, if you were to start every game down a knight, you're going to win some games, but over long periods of time, you're going to lose the majority of your games against an equal rated player. But every once in a while, you'll pull. It's no different to me. It makes sense. Well, if I'm down a piece, I'm going to win less games. Same thing with the sports. If every single time two NBA teams played, but every time one team got 10 points extra, which one's more likely to win over long periods of time?
Of course.
It's no different. That's the way I look at this same thing.
Except if the Cavaliers got the 10-point spread, they'd still end up tanking in the moment.
Yeah, that's kind of sad. But
let's bring it back. So our patrons are using both Little Book stocks and using the 8-pillar system to maybe create their own ETF. They're coming up with a process.
And we have our own, Mo and I have our own magic formula that we use ourselves. Doesn't back test as well as the magic formula, but it's stocks that I like that involve dividends more, which I tend to like.
And Mo, talk about why you guys use your own system as opposed to Little Book or 8-pillar.
We create it because we don't want to necessarily copy off of others. Plus, we want to collect those dividends. That's just income for us, coupled with the options that we are going to put on all of our positions, all of our covered calls that we sell. And so remember, it's just an additional way for us to get more percentages to beat the market.
And remember, dividends are tax inefficient.
Correct.
But I have the dividends for another strategy that has nothing to do with stocks. So that's why emulating our portfolio doesn't make sense for the average person, because I'm looking at real estate, businesses, and stocks all together, and I use each one to figure out how I can reduce. I always tell people, if I match the market, I'm going to beat the market because of my other strategies. So if I beat the market by a little bit, I'm a happy guy. I'm not trying to beat the market by 5, 6, 7% a year. Our friend Gary, over a 15-year period, has beaten the market by 6% a year. Awesome. I don't need to. He's also doing way more due diligence than I am, way more research. Diligence. If I just beat the market by 2 or 3% a year, I am beyond happy.
Yep.
And with our other things that we do, I do that. More than do that. However, in recent years, it has not been the case. So when we talk about Little Book, I think people should do the Little Book because I believe in it. I think it makes sense. I think it works. There's a lot of, go Google it. There's a lot of people out there that say, no, it doesn't work anymore because of X, Y, and Z. Just like value investing, you hear it doesn't work. Yes, he even says in the book, there will be 3, 4, 5-year periods of time where you're not going to beat the market when stocks are overpriced. What are we at right now? We're in a 5-year period of time where stocks have been massively overpriced where it wouldn't beat the market.
But even in the years that you're not beating the market, Seth, what did you do last year?
He beat the market last year.
I mean, you crushed the market last year.
Yeah, so the market returned 40, and I used Little Book stocks and got 59%.
So there you go. Years that you don't beat the market, there's your compensation of years that are just out of control.
So when it's all said and done, boys, we also advise very normal people to invest in ETFs. Continue investing in your ETFs.
Yeah.
Almost 90 to 95% of your savings should be in an ETF, right, Paul? For normal people out there, wouldn't you say?
80 to 95%, 80 to 100%. I don't believe in the whole. ETFs are great, guys. If you buy SPY or S&P index fund, or it doesn't have to be through SPY, you're going to do great just by matching the market, because 82% of mutual funds don't even beat the market every year. And the number that beat over a long period of time are even lower than 18%. It's probably a few percentage points. So think about that when going forward. We're trying to teach a mentality here and a mindset for how you approach investing. And the biggest thing is when the market's doing that, when the crowds are doing this, you got to do something else. Because think about it. If you match the crowds, you're not going to beat the market. And that's the issue that everybody has a hard time with.
So in the end, Paul, I want to bring it home. I talk to normal folks out there. Like I said, I bring your questions. In the end, people say, what is this show about? And I say, we want to get you guys in the mindset that number one is you can manage your own money. You don't need a financial advisor or something of that nature. You can take if you take all the time to make this money, take a little bit of time, a fraction of that time to manage it. And if you want to, you can start with not mutual funds with extra fees. Start with an ETF. This is basic. Invest in a simple ETF, not a crazy one like ARK, a simple ETF. You'll have millions and millions of dollars.
One that follows an index like the S&P 500, the Wilshire, the Russell, the Dow, something that follows an index that over time is diversified and goes up.
If you want more power in your hands, then perhaps you move to the Little Book that beats the market, Magic Formula stocks. This takes a process behind, instead of just an ETF, it takes a process of finding better companies that can beat an ETF. The goal is to beat an ETF, right, Paul? And in the end, we use our 8 pillars to screen maybe more, would you call it riskier plays, Paul? What in the
No,
end?
I'm sitting there saying as a screener for just understanding more about investments and then finding the stocks that you want that it might be ignored by the market, right?
Absolutely.
So when we come here, one of the things you said, Seth, is Seth uses the Magic Formula as his ETF essentially.
That's correct.
I'm okay with that for Seth. Why? Because he's here every single day. I can talk to him in his ear, and when he does something like sell EBIX because of fraud, I can slap him on the wrist and say, do not do that.
Yep.
You won't do that. So I need you to focus your retirement in ETFs. And if you want to dabble in Magic Formula with a percentage of your portfolio, by all means. If you want to add 8 pillars as the way of buying individual stocks, by all means. But I still think the majority should be in here. And if you can add a little bit of extra return through this, even better. With Seth, I love the fact that he uses this as his ETF. But it's because he's here, he's in my mind, I'm in his mind every single day talking about things. He actually does say, what would Paul do? Same with Tim and his wife. That's why it's okay for them. If you have that discipline, awesome. But there'll be a time when you go, this just doesn't work. Okay. I just don't deviate. Literally, I do not deviate. I haven't been in the market in 5 years, and look how much I've lost out on, and I don't care. The only thing that's hurt is my ego. That's it. When idiot 20-year-olds tell me I'm wrong. When I go to play golf at Firestone and the caddy tells me I'm wrong, I don't get growth. Okay, sounds good. That's what happened. He doesn't watch our channel. He watches...
You're going to have to eat that. I mean, value investors, we look...
But guess what? When the stocks do crash, and I go, told you, people say, well, you didn't say that it was going to happen because of this. I'm like, well, you had no reason why stocks were going up. So why should I have stocks will go down eventually. The excuse will happen. The spark that hits, I don't know what it's going to be, but overvaluation is all the gasoline in the room, and there'll be a spark that causes the room to blow up. So that's that.
That's our take. If you're interested in all 3 aspects, follow the show. We have a lot of videos in the past about Little Book, my returns, how I got into it. Every video, we almost look at every stock video, we look at our 8 pillars and how they can help define the ticker, whether it's overpriced or overhyped or underpriced. And of course, ETFs, we've done videos on those. They're rather boring because it's just a generalized fund. But in essence, the choice is yours as to how, I guess, a conservative or risky you want to be, or in how much you want to learn. Again, I always say, like, I see people, Paul, we have baby boomer parents, and I see a lot of them who've trusted a financial advisor. And it's kind of bothers me that they spent their entire life making this money and they didn't spend a few months of it just trying to manage it themselves.
For a few months. Few hours. Guys, if you do Magic Formula, it takes you 15 minutes once a year.
Once a year, yes.
And literally, you will at least match the market. I don't see how you don't even match the market over long periods of time. Over 5 years. It's just literally people spend more time researching the car they're going to buy than their entire retirement portfolio.
That's true. And so if you're
so sad.
If you're hesitant out there, watch more videos. If your spouse is incredibly hesitant, have them watch your videos and join the Patreon. We'd love to embrace you in there and join our 4,000 members. It's incredible. So tickle the thumbs up. We appreciate it. And we'll see you in the next video.